Imagine having a bank account with $1.2 billion in cash, but absolutely zero income, like nothing coming in at all.
Yeah, zero. Not a single dime.
Right, zero. And yet somehow you are valued at nearly $11 billion, all while 17% of Wall Street is actively taking out bets on your total destruction.
It is honestly the ultimate market paradox right now.
It really is. That is the bizarre, highly volatile reality of Oklo stock today. Is this heavily shorted company a falling knife waiting to trap retail investors, or is it secretly a fundamentally misunderstood gem that is dangerously undervalued?
You have this massive clash between a brilliant, world-changing narrative on one side and some deeply uncomfortable financial realities on the other.
Exactly. And today is April 22, 2026, and our mission for this deep dive is to sift through a massive stack of real-time market data, financial reports, and shifting analyst ratings to find the actual truth about Oklo, ticker symbol OKLO.
We are cutting right through the noise to figure out the mechanics of what is actually happening under the hood.
Yes, we are. But before we get into the weeds on that, I need a quick favor from you listening. Please like this video, subscribe to our YouTube channel, and leave your comments and feedback below. Honestly, it's compulsory if you want to keep getting these insights and surviving these wild market swings with us.
For sure. And just to set the ground rules for you before we start tearing into this data, what we're doing today is a natural human debate.
Right.
This is an analysis of raw numbers and market psychology.
Yeah.
It is absolutely not financial advice. We're just looking at the mechanics of the market, the why, and the how, so you can make your own informed decisions.
Okay, let's unpack this. Because before we can even debate whether the stock is a value trap or a rocket ship, we really have to establish the ground truth.
The baseline reality.
Exactly. We have to look at the cold, hard reality of the company's bank account today. And the numbers here will honestly give you whiplash.
They're staggering.
As of yesterday's close, April 21st, the stock was sitting at $62.61. The daily range was relatively tight, like $62.22 or exactly $69. But if you zoom out to the 52-week swing...
Oh, it's a completely different chart.
It is. This stock has traded as low as $19.89 and as astronomically high as $193.84.
That kind of volatility isn't just noise, right? It tells us a story about extreme market confusion. I mean, the market cap sits at roughly $10.87 billion, and it trades an average volume of about 13.3 million shares a day.
Which is a ton of movement.
Right. But to understand that volatility, we really have to look at the single most critical risk factor in Oklo's financial profile. It is a terrifying phrase for a publicly traded company.
Pre-revenue.
Exactly. They're completely pre-revenue.
Like $0 coming in from actual paying customers.
Literally none. When we crack open their Q4 2025 and annual financials, you aren't looking at a traditional business. You're looking at a massive cash-burning machine designed to build a future that hasn't arrived yet.
Yeah, the burn rate is wild.
Their net income dropped to negative $41 million in Q4 of 2025. And that bleeding is accelerating. It's notably worse than Q3, which was negative $30 million.
Wow, so they lost $11 million more in a single quarter.
Right. The trailing 12-month earnings per share sits somewhere between negative 71 to negative 72 cents. And their operating expenses shot past $82 million through Q3 of 2025 alone. They are hemorrhaging cash to develop their nuclear technology.
Okay, and this is a massive, but they aren't exactly broke.
No, not at all.
Right. I was looking at these balance sheets and a very specific analogy hit me. Oklo is basically a massive, heavily armored dreadnought ship, but it's sitting in a dry dock.
I like that.
Right? It is absolutely not out on the water. It has no forward momentum, no revenue flowing in. But man, its armor is thick. They have total cash of roughly $1.23 billion.
That is a massive safety net.
And they are virtually debt-free. Plus, their current ratio is 49.08. I mean, most healthy, functioning companies have a current ratio of like 1.5 or 2. 49 is just staggering.
It's unheard of in a normal sector. But what's fascinating here is how that current ratio actually functions mechanically. A current ratio of 49.08 basically means that for every single dollar of short-term liabilities they have due in the next year, they have $49 in highly liquid assets sitting in the bank to cover it.
That's insane.
If we connect this to the bigger picture, surviving a pre-revenue phase requires exactly this kind of high-liquidity war chest. Because when you are trying to commercialize next-generation nuclear reactors, time is your most expensive commodity.
Right, because the regulatory red tape takes forever.
Exactly. And that $1.26 billion in net cash from financing, which was mostly raised by issuing common equity to investors, is purely there to buy them time.
Which brings up a really massive contradiction. So they have over $1 billion in the bank, but no actual product to sell for years.
Yep.
That creates a massive vacuum of uncertainty. And when there's uncertainty, you get a war between believers and skeptics. If they're just issuing equity and burning cash, who is actually driving that 13.3 million daily trading volume?
That is the million-dollar question.
Right. This leads us into the order flow, and I'll be honest, the numbers here feel like two completely different realities crashing into each other.
The order flow is where we see the market's split personality on full display. This stock functions like a bizarre hybrid. Honestly, the best way to understand Oklo right now is that it is a venture capital bet masquerading as a retail stock.
Wait, I love that. A venture capital bet masquerading as a retail stock. What does that actually mean for the average person looking at their brokerage app?
Well, in private venture capital, you invest billions into a startup, knowing they won't make a dime for 5 years,
Right.
purely based on the potential of the technology.
Right.
That's essentially what institutional investors are doing here. Institutions currently own roughly 85% of Oklo's stock.
85%. That's massive.
It is, and they've been accumulating it heavily in early 2026. We are talking about big money buying $3 of this stock for every $1 they sell. They are playing the long VC game on the public market.
But then you have the skeptics. And they are aggressive. There is massive short interest here. We are looking at 24.14 million shares shorted.
That's a heavy, heavy bet against them.
It's 17.1% of the entire float. And here's the metric that jumped out to me. They have 2.5 days to cover. Can you explain the mechanics of what that actually means for the stock's volatility?
2.5 days to cover is a critical metric for understanding squeeze potential. It basically means that if some massively positive news dropped tomorrow and every single short seller panicked and tried to buy the stock back at the exact same time,
Close their positions.
right, to close out, it would take almost 3 full days of average trading volume just to process all those buy orders. It is an absolute powder keg.
Wow.
Shorting a pre-revenue stock with a billion-dollar war chest is essentially taking out a massive, expensive insurance policy on a house burning down while the owners are standing in the front yard holding $1 billion worth of fire extinguishers. It's wildly risky.
Okay, so I'm looking at the technical analysis right now, and I'm getting completely mixed signals. How can a stock be strong and broken at the exact same time? The chart is a mess.
Let's translate those technical indicators into plain English, because they tell a story of a stock fighting for its life. The overarching immediate trend is short-term bearish. It's been pulling back.
Okay.
However, the 14-day RSI, the Relative Strength Index, is hovering right around 64.7 to 66.03.
Which is basically dead center, right?
Right. It's strictly neutral. It's not overbought. It's not oversold. The algorithmic traders are sitting on their hands waiting for a catalyst. And the MACD, which measures momentum, is flashing a positive buy trend, sitting somewhere between 1.159 and 2.80.
Okay, so momentum is trying to shift. But
Yeah.
to your point about being strong and broken simultaneously, we really have to look at the moving averages.
Yes, the moving averages are crucial here.
Right, because it's trading at around $62 right now. That means it has broken above its 50-day simple moving average, which is sitting in that $59.61 to $61.63 range. In a vacuum, beating your 50-day average is a clear buy signal. It shows near-term strength.
Yes, but you really have to zoom out. It is still trading miles below its 200-day moving average, which is way up there, around $85.65 to $85.73.
That is a massive gap.
It is. That long-term average acts like a heavy ceiling. So yes, it's strong compared to last month, but the long-term trend from those massive $190 highs last year is still fundamentally broken.
So what are the key levels we should be watching?
Immediate support, the absolute critical floor it cannot fall through without risking a much deeper, uglier decline, is right around the $43 to $49.76 range. Conversely, it absolutely has to break through resistance at $68.14 to $72.44 to confirm a new bull run.
Okay, so the institutions are quietly hoarding shares like VC investors. The short sellers are circling with a 17.1% short float, and the technical chart is flashing conflicting signals everywhere.
It's a tug of war.
Which brings us to the inside of the building. And this is where my alarm bells really started ringing. Over the last quarter, insiders at Oklo have been dumping shares. Heavy selling.
Oh yeah, the insider selling is impossible to ignore.
Over 818,766 shares sold over the last quarter, which equates to roughly $50.9 million.
That is not just casually rebalancing a retirement portfolio.
Not at all. And here's where it gets really interesting. On April 1st, 2026, the CEO, Jacob DeWitt and the COO, Caroline Cochran, sold roughly $10.07 million worth of stock each.
On the same day.
Yes. Let me ask you directly as an investor listening to this. If the CEO of a pre-revenue company is cashing out $10 million of his own stock on a single Tuesday, why on earth should you or I be holding it?
It is the ultimate confidence test, and it rightfully makes the market incredibly nervous. Now, we do have to be objective. Insider selling isn't always an automatic death sentence. Founders hold massive amounts of equity, and sometimes they just want or need liquidity.
Right, they have to buy houses too.
Exactly. But the optics are terrible. When the C-suite is dumping over $20 million combined, while the company is completely pre-revenue, burning millions a quarter, and fighting off a 17% short interest, it absolutely fuels the bear thesis. It signals to retail investors that the people with the most information might be securing their lifeboats just in case.
And it completely muddies the waters with the Wall Street analysts. If you just look at the raw numbers, the consensus rating is a moderate buy. Out of 19 analysts, you've got 9 saying strong buy, 4 saying buy, 5 holding, and only 1 sell.
Right, the surface numbers look decent.
And the average price target is up around $90.41. But you can't just read those numbers like a textbook. What's the actual sentiment shift happening under the surface?
Sentiment is quietly fracturing. You have half of Wall Street pounding the table saying this is a strong buy because of the long-term potential. But if you look at the recent actions of the big dogs, UBS, Goldman Sachs, B. Riley, they all quietly slashed their price targets last month in March 2026.
They pulled back.
Heavily. They brought their expectations way down to the $60 to $95 range. They were looking at the cash burn, looking at the insider selling, and deliberately tempering their expectations.
So with the CEO selling, but some analysts still holding price targets above the current trading price, we arrive at the great debate of this deep dive. Is OKLO incredibly cheap right now? Or is it a classic value trap designed to crush retail traders?
Let's lay out the mechanics of both sides. The undervalued argument is based entirely on future forecasting. Financial models, like the ones from Simply Walsane, try to model out the future cash flow.
Even though there isn't any right now.
Right. They are essentially trying to mathematically predict how much money these nuclear reactors will print once they are finally online and powering the grid. Based on those far-out projections, they claim the stock is almost 47.8% undervalued right now.
Okay, so almost half off.
Exactly. From that purely theoretical perspective, grabbing it in the low 60s is an absolute steal.
But then you look at the present reality, and the value trap argument suddenly looks very compelling. If you look at the price-to-book ratio, it is sitting at a massive 8.2x. Fair value models based on current assets have repeatedly flagged this stock as heavily overvalued.
Which makes sense if you're only looking at today's balance sheet.
Right. So explain the mechanics of why retail traders specifically fall for this trap.
It comes back to the lack of a fundamental floor. Retail investors see the flashy headlines about nuclear energy. They see that 193 high from last year, and they think buying at $62 is, buying the massive dip.
A discount.
But they don't understand how a pre-revenue stock actually trades during a downturn. When a normal company with strong, consistent earnings gets hit with bad news, their actual profits act as a safety net. The stock falls until the price-to-earnings ratio gets so cheap that value investors step in and buy.
But Oklo doesn't have earnings.
Exactly. When bad news hits a pre-revenue company, there is no earnings floor to catch the falling knife. The floor completely falls out.
It's like stepping off a ladder, expecting a solid floor, and finding an empty elevator shaft.
That is exactly it. Combine that missing floor with the 17.1% short interest actively trying to push the price down, and retail traders can get obliterated if they aren't careful.
To really resolve this trap versus value debate, we have to look ahead. We have to map out the best case recovery and the worst case continuation lower. Let's start with the bull case, the skyrocket scenario. Why are institutions willing to buy $3 for every $1 sold? What is the massive catalyst driving that long-term hope?
The bull case is entirely predicated on a massive structural shift in the global economy. I'm talking about the AI energy crisis. We are reaching a point where a traditional power grid simply cannot handle the electricity demands of massive AI data centers.
They draw so much power.
Insane amounts. Tech giants are desperate for clean, reliable, continuous baseload power. That is why Oklo's partnership with Meta is so vital. We are talking about a 1.2 gigawatt nuclear campus deal.
And we really have to explain why that matters. A deal with Meta isn't just about the future revenue. It validates the entire business model.
Oh, 100%.
If you have one of the biggest tech companies on Earth lined up to buy your power, it completely de-risks the demand side of your equation. You no longer have to wonder if there is a market for small modular reactors or SMRs. The market is absolutely screaming for them.
Precisely. And it's not just Meta. You have the CEO of NVIDIA, the company literally manufacturing the chips, powering the AI revolution, publicly stating that SMRs are a foundational part of their future energy strategy.
That's a huge cosign.
It's everything. When the biggest players in the world pivot to nuclear to power AI, Oklo's core mission is perfectly validated. Throw in the current policy tailwinds like executive orders aimed at streamlining nuclear approvals, and the bull case says Oklo could accelerate their timeline and become the backbone of the new energy grid.
Okay, I hear you. The narrative is incredible. But I have to push back here. Does a signed piece of paper from Meta, or a nice quote from the CEO of NVIDIA, actually mean anything if the Nuclear Regulatory Commission takes 5 years to approve a single reactor design?
There it is.
Right. Which brings us to the bear case, the downtrend scenario.
This raises an important question, and it is the absolute foundation of the bear case. The timeline is the enemy. The worst-case scenario is driven by the inescapable reality that Oklo will likely not see meaningful revenue until 2027 or 2028 at the absolute earliest.
And in the stock market, 2 to 3 years of waiting is an eternity.
It's a lifetime. During that massive waiting period, the narrative can crack. If you have heavy insiders selling, slowly sapping investor confidence month by month, and a 17.1% short float constantly applying downward pressure, the stock could bleed out. Professional traders are betting hundreds of millions of dollars that Oklo stumbles on the regulatory hurdles before they ever split an atom.
So what does this all mean? It really comes down to short-term survival versus long-term vision. Short-term, the stock is fighting technical resistance, relying entirely on its $1.2 billion war chest, and desperately trying to hold that $43 to $49 support floor.
Yep.
But long-term, it's a binary bet. It either becomes a foundational piece of the 21st century AI energy infrastructure, or it burns through $1 billion of investor cash and fades into history.
It is the ultimate high wire act.
It really is. Okay, to quickly recap the core tension we've unpacked today, you have a company with world-changing potential, backed by massive institutional money and AI data center demand. But that is completely at odds with its current pre-revenue reality, a heavy short interest, and multi-million-dollar insider selling.
A lot of conflicting signals.
Exactly. We won't have to wait too long for the next major clue, though. The immediate upcoming catalyst is their Q1 2026 earnings report, which is due on May 12, 2026.
That earnings call is going to be incredibly revealing, especially regarding their cash burn rate. But I want to leave you with one final thought regarding the ultimate downside risk. Oklo's entire survival narrative hinges on deploying its first 75-megawatt commercial reactor in Idaho by 2027.
Right.
We know the NRC is notoriously slow and methodical with approvals. If regulatory delays step in, and let's be honest, they almost always do in nuclear energy, and push that timeline back to 2029 or 2030, you really have to ask yourself a hard question.
What's that?
Will that $1.23 billion war chest be enough to survive a multi-year delay, or will investor confidence completely shatter before the reactor ever gets turned on?
That is the multi-billion-dollar question hovering over every single share of the stock. And that is exactly why we do these deep dives, to look past the headlines and understand the mechanics underneath. Thank you so much for joining us on this one.
Always a pleasure.
Remember, if you found this breakdown helpful and want to keep navigating these markets with us, hit that subscribe button, drop a like, and leave a comment below with your thoughts on Oklo's future. Are you buying the dip because of the AI energy crisis, or are you staying far away from the value trap? Let us know. Until next time, keep questioning the consensus.